What we're going to be looking at today is FRS 102. Over the years, we have had a whole host of UK accounting standards. So it's replacing all SAPs. The only SAP I can remember still is SAP 9, which I think was inventories, except it was stock, because stock is the British word that we're still allowed to use. FRS 1 came in 1991 or 1992 when I was still at university, and since then we've had a whole host of FRSs and UITF abstracts coming through. So they've decided to pick up the whole bundle of them and replace them with a bunch of other standards. So if anyone has ever used a Frizzy for accounting, the smaller companies FRS, it's effectively doing the same thing. You're now just going to have one book that tells you everything that you need to do for UK accounting standards. Now, because we are part of the EU, we've had to adopt the international version of things, but we're maintaining it for the Companies Act as well. So we've got a few little tweaks, which is why the standards are being revised every few months. We had a version in August 2014. The version that you will need to use next year is the September 2015 version, and goodness knows what they'll produce after that. They constantly have to keep looking at it. They've said it's going to take about 3 years to go through, work out all the glitches, and then do another version of the standard, and then they're planning to revise it every 2 to 3 years after that. But for most of you, it will be the September 2015 version that's going to be most relevant, with a few of you using the August 14 version as well. Now, they launched the September version for anyone that is a small company. There is a special section, Section 1A, which is dealing with small companies, where you have a very discrete version of the standard, which means that you can go out and actually produce a smaller set of accounts. Now, there's a very good reason for this. The small set of accounts is effectively replacing abbreviated accounts. I don't know if any of you filed abbreviated accounts at the moment. Yes? Did you realise they're going? They're completely disappearing from next year. So we've got a few choices that I'll be running through with you because they've decided that abbreviated accounts are to be no more. We must now publish a version of accounts with notes and other things attached to them. So whether you were small or medium, abbreviated accounts have disappeared. Everybody will be using Section 1A if they're a small company. They'll be using the main standard if they're a medium-sized company. And if you're a micro business, you can do all sorts of other things as well. So, I've mentioned the sizes. Let's take a look now at who's going to fit in where. Now, the thresholds are changing quite a lot. At the moment, most businesses are fitting within the small and micro companies regime, but if you were previously medium-sized, you may be one of the 11,000 that's dropping down within these new size criteria. So we did have a small company with turnover of up to 6.5 million. Now you're going to be able to go up to 10.2 million as well. And that's going to open up the audit exemption for a few people as well. Although that may or may not be appropriate, Ian probably wants me to say, depending on the type of business that you are. Now, the medium-sized companies, their limit is moving up to 36 million. So there will still be some companies there that fit within those size limits, but most of the businesses will be fitting within the small companies regime. Right down at the very, very bottom, we've got the micro companies with 632,000 turnover. Now, these are going to be the little businesses, the one-man bands, who have one shareholder who also happens to be a director. They have looked at the whole of FRS 102 and said, actually, they don't need to apply any of this stuff. And to meet an EU directive, the micro companies just have to file something that doesn't even look like a set of accounts. There are about a dozen headings altogether where you have certain criteria that you need to meet for things to go in there, and you don't even have to publish any notes to go alongside them. There may be a few little details that slot in. Apparently, those company accounts will be sufficient to meet HMRC's regulations as well. It remains to be seen how many inquiries they launch. But micro companies, I'm assuming none of you are within those size limits. We're going to be looking at the small and medium. Now, the thresholds still follow exactly the same 2-year basis as we have at the moment. So, you are allowed to adopt the small companies regime if you are currently medium-sized, but you will be small in a few months' time. if you want to, because the previous year and the current year will both count. It will take 2 years to drop out of any of those regimes as well. So if you're currently a small company, you don't immediately have to leap into the medium-sized regime until you're really ready to. You've got a little while to bring your books and records up to scratch so that you've got all of the additional information that a medium company would need. We have got the 2-year rule. We've got a number of companies that are dropping down, but you've also got the group regulations as well. So, now with the groups, we've got the medium and the small rules. Now, if you are a small parent company, you have to make sure that all members of your group are also small before you can adopt small group rules. If you are a medium group, that's not obviously going to be an issue for you. So the group criteria are going to be important for assessing the size of the parent as well as the size of the group itself. The parent company can only qualify as being small if it meets the small company thresholds itself on an individual basis, and the group it heads up also qualifies as being small. But many of you will be in the medium size regime anyway. We've also got some additional rules for groups that wish to apply the small group criteria. So there are a few exemptions and things that apply to groups of companies rather than individual companies, where you don't have to publish things like cash flow statements. So there is a long list of exemptions that will become available to some of you if you meet the small company rules. But you have to go through and look at the criteria on a one-by-one basis to decide if they apply to you or not. Now, the useful bit, trying to work out which set of accounts you can possibly go for. Now, do any of you use a FRS at the moment if you're doing abbreviated accounts? No? So if you were a small company with turnover of 4 million, you've actually got 3 choices that you can use at the moment. Now, if you have a September 15 year end, it means that your accounting year end didn't start before FRS 102 came into being, so you are still within the standard UK GAAP rules. So the really small companies can go for the old FRS, a new version of the FRS, or they can apply standard UK GAAP with the SAPs, the FRSs, everything else that they've been doing to date. If you're a medium-sized company, you can, if you want to, early adopt FRS 102. But I doubt if many businesses have done that at this point. They're hanging on until it settles down a little bit. Now, the challenging one is if your year end is the 31st of December 15. We've got any December year ends? Here we go. So, you are already in the regime then, in that case, because your trading year started on the 1st of January 2015, and you have got choices as to whether or not you wish to potentially early adopt the small company rules or go straight into the medium-sized criteria, obviously depending upon the size of your business. Now, if you do early adopt, then you have got to apply all of the rules and regulations. There are no opt-outs, and you also lose the ability to file abbreviated accounts. So you have to make sure that you are following the right version of FRS 102, you're following the New Companies Act criteria, and you're making sure that you are applying all of the rules and regulations appropriately. So, if you have a 31st of December year end, you are already in the regime, you should already be thinking about how to transition. If your year end was earlier, you have got a few more months before you need to move everything across and produce your first accounts. With the December year end, your first FRS 102 financial statements should be about to be prepared at the end of the month, which means that you would have had your last UK GAAP accounting period 12 months earlier, but you needed to actually start thinking about FRS 102 12 months before then. Now, depending upon when your year end is, you may just need to shuffle those dates forward by another 3 months, 6 months, or 9 months. But from the look of it, most of you will already be within the FRS 102 regime. Now, what we're trying to do is make sure that we have got a set of accounts at the 31st of December 15 that meets the new criteria, but the old accounts as well have to be transferred across. So to transfer those old accounts, you need a new opening balance sheet 12 months earlier, which has also been prepared under the FRS 102 guidelines. Now, they've tried to make it as easy as possible. They've said that when you do a reconciliation of profit under the new rules and the old rules, you just have to put those figures to one side and put them within equity in the financial statements. You don't have to go out and produce a balance sheet at the 31st of December 13 and publish that as well, but you do need to actually start putting everything into the FRS 102 criteria. Now, the transition balance sheet can only recognise items that have been permitted by FRS 102. So, you've got to go through the measurement rules, you've got to look at the recognition criteria, and you are only allowed to include those items on the correct basis. You cannot just move things across as they were. Any adjustments have to be recognised within retained earnings, and there is a reconciliation statement that's been published that's Ian and Co will be looking at with you when you actually have to move across. That's going to highlight the adjustments that have been made to move from the old rules across to the new ones. So obviously, if you've got a March year end or a June year end, you'll be doing all of this a few months later, but you really do need to start looking now at the sets of accounts that you've previously prepared and try to work out if you've got all the information available that you'll require. Now, in terms of the language, I said that anyone who has qualified within the last 10 years or so is probably going to be a little bit easier with this than the rest of us, who are a little bit older. Now, we've tried to amalgamate the international terminology from the IFRSs and the Companies Act terminology. There were suggestions that we should just abandon the Companies Act terminology altogether, but people said, hang on a minute, that requires a change of law. So we are allowed to actually take the FRS 102 language and continue to use the UK version if we want to. Now, if we start off with the basics, I grew up with a balance sheet and a profit and loss account, but now you're going to have statements of financial position and statements of financial performance. Now, as those are not mandatory titles under the Companies Act, you may actually increasingly see more and more statements of financial position and statements of financial performance, particularly when you're benchmarking and comparing against other companies. We've also got a couple of new statements coming in, Statement of Comprehensive Income and the Statement of Changes in Equity. Now, the Statement of Comprehensive Income takes your profit and loss account and it sticks in a few extra lines for things like revaluations of property, maybe movements on financial instruments as well that don't go through the P&L. So those are now put together in one place, and then our Statement of Changes in Equity moves from one balance sheet equity position to another. So you're going to have your retained earnings, your share capital, your share premium, your revaluation accounts, and if you're in a group situation, your non-controlling interests, and they are going to show what has actually happened during the year. So if you've had a bonus issue of shares, if you've paid dividends, if you've had a rights issue, if you've revalued a property, all of that information will go into this additional primary statement that we haven't had to prepare before in the UK. Now, the UK version that was closest to any of these was what we called the struggle, the Statement of Total Recognised Gains and Losses, because it was difficult to produce. Now, that has completely been axed, so you will no longer see any of those in sets of financial statements. It will now just be comprehensive income and statements of changes in equity. Now, in terms of the rest of the terminology, these headings here for tangible fixed assets, stock, turnover, and tax on profit will remain using the UK format. So we have got a clause in FRS 102 that says we can use similar phrases to property, plant and equipment, inventories, revenue and income tax to make them more understandable, which meets the Companies Act criteria. So we're going to end up with a bit of a mismatch between the UK versions and the international versions, but you can mix and match most of them if you need to. Now, in the UK, we've had a cash flow statement for a number of years, but small companies have been exempt from having to prepare one. Now, under the new FRS 102 format, even a small company will have to prepare a cash flow statement, but just to make it even more confusing, it's going to be a statement of cash flows. So they've switched the words around, a little bit. So it's one of those things that you learn how to do when you're at college studying for your exams, and then you forget about it unless you need to. So you might need to dig out the old textbooks again to work out how to actually put the cash flow statement together, but every company, apart from the micro ones, will now need to produce that. The only exemption now in cash flow statement terms is with groups, where if you have a parent company or another member of the group which is publishing a cash flow which is publicly available, then you have an exemption. So everyone else will have to produce their cash flow. Now, the transition balance sheet is going to have either of these new names in there, so it may be referred to as a balance sheet or a statement of financial position. It's just really, if you're looking at other companies, you'll be getting used to the new language and what's actually required. So, we've got the new terminology, we've looked at when you're going to have to do things. The next bit are the key changes for you. Now, some of these areas will apply to some of your businesses, others may not, but every business is going to have to decide on a case-by-case basis which elements of the new FRS they're going to have to deal with. Now, what I suggest you do is grab a copy of the new standard and just look at the bits that are changing. The Institute of Chartered Accountants has actually produced some really helpful guidelines where they've said these will apply to most companies, these will apply to very few companies, and you've really got to be a special case to if these changes here apply. So what we've done is looked at the ones that will apply to a lot of businesses and come up with some key pointers for you. Now, some of the key areas are going to relate to fixed assets and how they're going to be valued. You're also going to have to look at things like investment properties. You may have to cover leases. You may also have some financial instruments where you haven't necessarily had to deal with them before. So you might have to look at how items are being valued, how they're being recognised within the financial statements, and then any knock-on consequences for your tax as well. Now, if we work our way through these step by step, the deemed costs and the fair values will link to your fixed assets. Goodwill and business combinations may only apply to a couple of businesses here in the room, but it's worth knowing how those are put together. Amortised cost, it's a whole new way of valuing things. So you might have to get the calculators out again to work out effective interest rates and other interesting calculations there. Operating leases, there are quite a few changes in the disclosures there, so the sets of accounts that you'll be looking at may actually be very different to the ones that you've seen before. Component accounting may or may not apply to your businesses. It really depends upon whether you've got properties in place or if you've got some big chunky assets that we can break down into different parts. And then every single one of these areas is going to have an impact on your deferred tax liabilities as well. Now, if all of these key areas are changing, as well as some of the others, some of the little bits like bonuses, employee pay, employee benefits, it could potentially have a knock-on effect on other parts of the business. Now, if you have loans in place with some loan covenants attached to them, your bank manager may be very keen to understand how your new balance sheet is going to change compared to the old one and the impact on the ratios that you have. So if you have a loan with any covenants in place, you might need to go back and actually look at those changes and decide if you're still going to meet them over the transition period. If you've got performance-related pay and bonus arrangements, again, you might need to take a careful look at them to work out the criteria on which people are being assessed. If people have got particular profit-related performance measures and suddenly you're having to change how much goodwill goes through the financial statements or you're changing your depreciation charges, your employees may not be happy if it means they lose their bonuses. So you need to go back and actually look at all kinds of knock-on effects from this to see how you will be affected by the changes. So you're going to have to work your way through, bit by bit, reviewing the terms and conditions of any contracts you have in place, making sure that you've got measurements in place for all of these areas, and also if you're in a group, that the parent companies understand how your new accounts are going to look. Now, in a group situation, we've got a number of exemptions, particularly over the transition period, and you have to get the parent companies to agree to those transition arrangements. So it's worth having a conversation with your parent companies, whichever regime they themselves fall within, just to check that they understand that you are moving into a new set of financial reporting standards and the changes that are going to take place. Now, I'm going to run through some of these with you next. And then after that, we've got a chance to look at a couple of other areas as well, just some little twiddly points that people are worrying about. So the first one are deemed costs. Now, the deemed cost rules. These apply in theory to all items of property, plant and equipment, or tangible fixed assets, as we said in England, investment property and intangibles as well. Now, when they wrote the standards, they decided that everybody was going to so much effort to move from the old UK GAAP into the new version that they needed to give a few little perks and benefits of doing so. So imagine the scene. A few years ago, well, more than a few years ago, you bought a small patch of land in the Sandbanks area of Poole. You then managed to build yourself some nice, rather attractive offices there, and then the property market took off. Your small patch of land in Poole, or maybe in central London, is now worth millions rather than the thousands that you originally invested. Now, under these rules, you're actually allowed to revalue your property on moving across to FRS 102 using a single one-off revaluation. So you're unlikely to want to revalue a computer because you've got to do it at fair value, and let's face it, Ian's laptop probably isn't worth the paper it's standing next to now, but other areas you probably will want to go out and revalue. They have given you a little perk in that you can pick and choose and cherry pick for the first time what you actually want to do. Under the traditional accounting rules, whenever you have revalued, you've had to revalue an entire class of assets. This time, you don't have to. So if your prime asset is in central London or in Poole, you can revalue to your heart's content. But if it's like my parents' cottage which fell down a mine shaft in Cornwall, you might not be so keen to revalue it. So you can pick and choose each item and then put the new value in your balance sheet. It doesn't even have to be a brand new valuation that you're putting in. It could be that you had a valuation done a couple of years ago, maybe for insurance purposes or something else, something fairly recent, and you decide that that is the value that you want to run with. So you can put that in instead of your old original cost, and then you'll continue to depreciate it and treat it as you would the historic cost of the item. If you do perform a one-off valuation, you may decide, actually, this has inflated the value of our balance sheet. We're looking a bit stronger. It's a good thing to do, and you may wish to continue with that in the future. But under the deemed cost rules, you don't actually have to. You can do it as a one-off and then strengthen your balance sheet and take it from there. Now, if you do go for a deemed cost valuation, you do need to back it up. So we would either need a proper valuation report, which incurs expense, or you would have to have evidence of the property value. So if you are in a trading estate, for example, and you can actually prove the value of some of the other properties in the area, you may not necessarily have to go out and incur the surveyor's costs and the estate agent's fees and such like. But it's a handy little quirk within the system that they're letting you do this. So deemed cost, it's a one-off revaluation on the transition date. After that, you can either leave that as your new cost and continue to depreciate, or you can keep going with the revaluation model, and hopefully if the property market continues to go up, it will keep going up and up and up. Now, it doesn't just apply to PPE, it's also investment properties, which are going to have to be valued under the revaluation method each year anyway, and intangible assets as well. So if you've got some acquired brands, maybe within your business, it may be worth actually looking at those intangibles and trying to decide if there is a value that you can work out for them. So if you have any other intangibles, again, you may decide, any licenses or what have you, that there is a market, you can get a fair value valuation for them. Now, unfortunately, this doesn't apply to anything that's been internally generated. So you cannot go out and say, actually, we've got a fantastic brand that we've built up ourselves. But if you've purchased something, it may be an opportunity to make your balance sheet look a little bit stronger. So, under the deemed cost rules, if your historic cost bears very little resemblance to the market value, you can do a one-off revaluation, pop it through the financial statements now, and then away you go. Continue under the old method. Now the next bit is looking at the fair value of investments. So we've got a lot of fair value rules that you're going to have to get to grips with over the next few months. Fair value accounting has been within the under the international framework for many, many years now, but we haven't bothered with it quite so much here in the UK. So under the rules, we've got any shares which are publicly traded, or if their fair value can be measured reliably, must be measured at fair value with changes in fair value going through the P&L. So if you have a portfolio of investments, any movements in those, if you've got shares in a PLC, now have to hit your profit and loss account, improving or decreasing your trading performance. Anything else, you can just measure at cost less impairment, because they're not going to have this readily available value attached to them. Now, I can see that a number of you actually switched off at that point because you're thinking, why on earth is she talking about shares? But it's actually not just shares. Under the guidance in FRS 102, we keep being pulled back to these paragraphs that tell us which items must be valued at fair value, and the ones that will be are all of these. So, when you acquire a business, or if you acquire a business which already has inventories, then those must be valued at fair value. After that, we go back to traditional cost and net realisable value rules. Investment properties must always be valued at fair value. Property, plant and equipment, well, you've got a choice. You can follow the revaluation method, or you can go down the cost and deemed cost approach. Intangibles, anything other than goodwill gets included as well. When you're looking at impairment of assets, so as I said, my parents' cottage fell down a mine shaft, that was quite heavily impaired, you've then got to work out the fair value of what was left over. Employee benefits, so things like pension schemes, share options. Financial instruments, a phrase to fill most people with horror, and any business combinations. All of those have to follow the fair value rules, which are exactly the same as the share-based rules. Now, we've been given a hierarchy for working out what our fair values are going to be. Whenever possible, you should have a quoted price. Now, that's absolutely fine if you are dealing with shares, because you can go out, you can find out exactly how much a share is worth on a particular point in time if it's publicly traded. But if you're looking at things like properties or brands or intangibles or investment properties, it's a little bit trickier because there's not this open market value for transaction where prices are available day in, day out. So they've said, okay, not everyone's going to be able to get a quoted price, so let's try something else instead. Let's look at recent transactions. Now, a recent transaction is only going to apply if you have an identical asset. So it has to be incredibly close to the item that's within your balance sheet. So if you are a steam railway, you would have to find the equivalent of Calbourne and Freshwater on the Isle of Wight to be able to value those. Am I showing I know what I'm talking about?
I do.
Good. So we're going to have an identical asset that you are able to value. It has to be exactly the same so that you can actually match it, and it has to be available in an active market. Now, with an active market, you're going to have buyers and sellers who are always available, who are always willing to make a deal with you. Now, imagine the scene. If you are down at the Bournemouth railway station, there are going to be taxi drivers out there, aren't there, who are going to be sitting around muttering and mumbling about how hard their life is and how horrible their customers are at this time of year. A few of those might be willing to give up their taxi licence at any point. There is probably an active market for a taxi licence within a specific area. There's going to be an active market for things like shares. but there's not going to be an active market if you're trying to place a value on something like a brand. So if instead of buying and selling a taxi licence in Bournemouth, you're looking at buying and selling Coke versus Pepsi, you're going to find things a little bit tougher because there isn't an identical transaction that has taken place in recent times. So if you can't find a quoted price and you don't have a recent transaction for an identical asset, the next best one is the arm's length basis. Now, under the arm's length basis, you're going to have to work out what would happen if a buyer and seller came together and they were motivated by normal business considerations. Now, this makes life a little bit complicated because obviously the seller is going to want as much money as possible, the buyer is going to want to pay as little as possible, and it's all going to come down to negotiation, isn't it? So I hate to say it, but when you're estimating your fair value, there's going to be a massive amount of judgment in there, and I've got a feeling that the auditors are going to love it. Yes? Because you're going to be coming up with all of these ideas for how your fair values have been arrived at, and then you're going to have to argue the case for each one. So you may potentially have two almost identical businesses with almost identical assets, which could be placing fair values on their assets in a very, very different way, simply because of the arm's length basis rule. Now, those fair values, remember, apply to all kinds of things. So, your inventories, well, you could probably get a cost for those. Investment property, it's going to depend upon where the building actually is. Is there going to be publicly available knowledge, information on how much that's worth? Property, plant and equipment, well, you might need to do this for impairment reviews, trying to work out what the overall value will be. Intangible assets, going to be really tough because you're very rarely going to have that active market for an identical asset. Employee benefits, I'd pass that one to an expert in a lot of cases, I think, particularly with things like the pension schemes. And then the financial instruments, it depends upon the nature of the instrument, whether or not you've got forwards or futures or what tucked away that you can actually get those values on. And then, of course, we have business combinations, where I think I'm going to come back to that one in a little while. So, fair value accounting, you need to get to grips with how you're going to place values on these items where you haven't necessarily had to do so before. Here we go, business combinations, goodwill. Now, I don't know how many of you are actually in groups of companies where you've got the classic acquisition of the subsidiary. But the way the rules worked, we always paid one amount, but we bought something completely different. And then we had to match it up with a balancing figure that you'd negotiate over in the middle. So goodwill is still calculated as the difference between what you're giving and what you're getting, but we're now going to have different recognition criteria. Now, if you have a subsidiary company that you bought a few years ago, when you transition across to FRS 102, you may or may not wish to revalue the business on the acquisition date. So there are rules that say you can go back and bring in things like your intangibles, contingent assets and liabilities at a new basis. But if you acquired a subsidiary 20 odd years ago, that's going to be virtually impossible to do. So you may just be able to transition across using the figures at the old date, at the transition date. If, however, you're planning to make acquisitions in the foreseeable future, you will have to go through following an entirely new set of rules to work out how much that business is worth. Now, on a one-by-one basis, in the past, things like brands have been subsumed in the UK within goodwill. Now you're going to have to actually go out and place a value on those brands, as they will be separately recognised within the financial statements. So if you're acquiring a company that's built up an excellent reputation over the years and the brand name is well recognised, you are going to have to actually put that in as an intangible asset. With the contingent assets and contingent liabilities, they have previously been included on a best estimate principle. So we've looked at them and we said, yeah, actually, they may be worth this amount. Now they're going to have to use the fair value rules. So you're actually going to have to look at all of the contingencies that may or may not be in place when you're acquiring another company and work out what an active third party would be willing to give you in respect of that amount. So how much would a third party be willing to be paid to take over a contingent liability, and how much would they be willing to give you to take over a contingent asset? Now the thing is, with contingent assets and contingent liabilities, they are just possible items. They may not actually come to fruition at all. But under these rules, you've got to treat them as though they are actual liabilities and place a value on them when you're combining businesses. So you've got to work out what would a third party do in this situation. Then deferred tax. Now this one is going to keep coming back to haunt us. Every time the rules change within FRS 102 compared to UK GAAP, you've got to look at the deferred tax consequences. So they're now placing more values on items and calculating the deferred tax that goes alongside them. So if when you acquired a company, you bought a factory and some other items, you've now got to make sure that you've accounted for the factory at its valuation and the deferred tax on that valuation as well. Previously, you didn't have to worry about the deferred tax consequences. So suddenly your deferred tax liability may be getting a bit bigger than it previously was. Now, there are exemptions in place for businesses transitioning across to FRS 102, but you still need to look at the deferred tax consequences, even if you do follow those exemptions. So if any of you are in a group situation and you've made some acquisitions over the last few years, I strongly recommend you take a look at that section on business combinations in the standard. Read it very, very carefully to work out what you need. So, when you're looking at a business combination, and it's not just going to be a parent buying a subsidiary, it could be buying an unincorporated business as well, you've got to go through and value everything on an appropriate basis. It's not just when you're actually acquiring a business that the rules are changing. Have any of you got goodwill in your balance sheets at the moment? And don't ask me about negative. Anyone got some positive goodwill? Yes? Now, under the new standard, we have to assume that our goodwill is not going to last any longer than 5 years, unless you've got a very good reason and you can place a reliable estimate on it. Now, 5 years isn't actually a very long time. Traditionally, we've always written it off over 10 years or 20 years, haven't we? Or we've let it sort of carry forward in a sort of vague way within the books. Now, they have actually let us, under the new standards, continue to amortise. I think they decided that making us impair goodwill, as anyone who's done international standards over the last few years is familiar with, was a step too far. Here in the UK, we like our nice regular chunks of goodwill going through our profit and loss account, but potentially you will now need to look at any goodwill that you are carrying forward and decide whether it meets the criteria for its actual useful economic life, or whether you were sticking your finger up in the air at the time and you plucked a number out of thin air. If you have not got a reliable estimate of the useful economic life, it is assumed that it is 5 years. Now, if you were previously writing your goodwill off over 20 and now you've got to write it off over 5, that could be quite a big hit in your profit and loss account. So you will then have the knock-on tax consequences as well, and you might have to explain to a few other people why your P&L account has suddenly taken a massive hit in one particular set of accounts. So check very carefully whether or not you can justify the existing useful economic life. You may have to dig out things like advertising costs, promotional events that you've been doing, anything to raise the public's awareness of your business and maintain that goodwill. If you've got evidence that can justify a longer life, all well and good, but if not, we have to assume that it's going to be written off over 5 years. Okay, anything else on goodwill? No? Now, I was chatting to Dean before this started, and Dean was telling me that he's currently doing some amortised cost calculations. So at this point, I feel that I really ought to hand over to you, Dean, as you are the person who's going to know what's going on.
I wouldn't want to steal the spotlight, to be honest. So.
No? Okay. I will continue. But we were discussing taking exams, doing your courses at Kaplan, and I was trying to prevent you just now from leaping in to do your F9 paper, wasn't I? Yeah. You, therefore, are probably one of the only people in this room that doesn't have the excuse at the moment of not knowing how to do an internal rate of return, as you haven't taken it yet. Now, when the rest of you were doing your accountancy qualifications and exams, I'm sure you came across net present values and internal rates of return, where you were having to do all sorts of complicated calculations with 5% and 10% and trying to work out when your net present values became zero. Unfortunately, now for a lot of financial transactions, you're going to have to go back and look at these same rules again, because you're going to have to work out effective interest rates for some of the loans and other transactions that are in your books and records. Now, if you're going to your bank and you are setting up a loan arrangement or a mortgage, or maybe you're issuing some loan stock or doing something else exciting, you're going to have all of your transaction costs, which must now be built into the loan package and recognised in the profit and loss account over the life of the loan. Previously, if you were taking out a mortgage, say you paid a £2,000 arrangement fee for a mortgage or a loan, you could write it off immediately. Now you've got to wrap it all up within the overall financing arrangement and write it off over the entire period. You're going to have to work out potentially discount factors that you can use to calculate the effective interest rate for all of your financing transactions, and then write those off as finance costs over time. You're going to have to apply it over the life of the transaction. Now, at the end of each year, whenever your balance sheet date is, you will then be recognising a different value potentially to the amount that's shown on your bank statements. So you will have to follow what we're calling the amortised cost rules. That's going to be equal to your balance brought forward, any finance costs that you've calculated using these effective interest rate rules, less any interest that you've physically paid the bank to give you a balance carried forward. Now, it's a complicated transaction. There are all sorts of spreadsheets and things available, but it's going to apply to a lot more loan transactions than we've previously needed to use it for. As I've said here, it's not just bank loans. If any of you have got intercompany loans in place, potentially those are under market value. So you will have to work out what an effective interest rate would have been unless you meet specific criteria, and then factor those interest rates into your calculations. If you have a director's loan in place, you don't always know when that loan will be repaid. It's typically going to be an interest-free loan. You will have to look very, very carefully at the terms and conditions because you might need to compare it to a market rate of interest. It's not just going to be these either. Rumour has it that sometimes banks will offer transactions at below market value. There may be a particular discount compared to other businesses that they're willing to offer you. If you've received one of those preferential loan terms, again, you have to actually account for the loan at market value and then apply the discount as you are continuing to account for the transaction. Now, it's a really tricky area. So if you have any of the transactions that I've just mentioned, directors' loans, intercompany accounts, bank loans that may not necessarily be at the market rate of interest, there are specific help sheets that have been published. The ICAW in particular have got a checklist where you work through all of the terms and conditions to make sure that you are accounting for the transaction appropriately. Now, it may be that you've got a director's loan at no rate of interest with no fixed repayment terms that won't fall within these criteria. But you just need to be aware that some transactions that you've previously just been able to carry forward at the loan balance will no longer be allowed to do so. You will have to work out the interest rates that go alongside them. So, not just bank loans, directors' loans, intercompany loans as well. Complicated rules and regulations that are worth looking into. So, operating leases. Anybody rent a photocopier? Any other rental equipment? Yes? You've got new disclosures to make. If you've got some property that you're renting or any other larger items, there could be some quite fundamental changes to the way in which you do things. Now let's start off with lease incentives. So, Here you are, in your rented building, minding your own business, dealing with things as they crop up, comfortably aware that you've taken out a 50-year lease. If you have a rent review over 5 years, you would previously have been able to write off any lease incentives to the point of your rent review. Under the new rules, you're not allowed to do that. You now have to write off any incentives and look at the full cost of the lease over the entire period of the lease. Now this means that potentially you could end up with a significantly different figure if you've got a long leasehold in place. So if you did receive some incentives at the start, maybe a rent-free period, then you've got to now account for those over, say, 50 years instead of over 5 years. It's just worth looking at your contracts and seeing if you have got anything in place that you need to account for slightly differently. The bit, though, that's going to affect most of you are the disclosures. So, under the UK rules, and it's a long time since I've had to do any of these, I think you have to disclose the payments you're going to make over the next 12 months, isn't it? Yeah, so nice little calculation. You look at your contract, you take your 12 monthly payments, one number in the accounts. Unfortunately, it doesn't work like that anymore. Under the new standard, you have to disclose all of your operating lease commitments over the entire life of the lease. So if you take out a lease for 50 years, you're going to have a walloping big number down at the bottom of your disclosure that shows the payments you've got to make over a 50-year period. That could actually make some of your shareholders turn grey if they haven't already done so. So you're going to have to now disclose all of your operating lease commitments over the full period. The disclosure is going to look very different, and this is why you might need to start training and educating other people, because suddenly if you're trotting off to the bank to look for some finance and the bank manager, who's not used to FRS 102 because they haven't received much training, looks at it and thinks, hang on a minute, that's an awful lot that you've got to pay over the next few years, then you need to explain, actually, it's over 10 years or 20 years or 50 years. So the commitments are going to be very different. So operating leases, it's the disclosures and the lease incentives that are going to cause you most problems. Then, one of my favourites, component accounting. Now, if I was doing a day job at this point, I would probably start running around the room pretending to be an aeroplane. But as I'm with grown-ups, I'd better not do that. So, but at some point I'm bound to stick my arms out to pretend to be an aeroplane because it's been drummed into me over the past few years. If any of you have got buildings within your balance sheet at the moment, you might need to start to think about breaking them down into different bits. So, if you've got a property, what's the bit up at the top? Roof. What holds the roof up? The walls. And then you've got wiring and plumbing and other things that are within the fabric of the building. Now, if you have a roof, you hope it's going to last for a considerable length of time, but it's probably not going to last as long as those walls, is it? So the walls might be there for 50 to 100 years. The roof might need to be replaced every 10, 15, 20 years. Now, with component accounting, we've borrowed something from international standards just to make your lives tricky, and we've said you need to break a building or any other substantial piece of property, plant and equipment down into its component parts. Then, once you've got the different components, you can depreciate them all separately. So, with your roof, what did I say for the roof? How many years? 20. So, you write your roof off over 20 years. Your walls, you can write off and depreciate over 50 or 100 years. The electrics, depends how good your electrician is really, doesn't it? Might be, say, 10 years, might be 20. And then you write it off bit by bit. Then, the fantastic bit, having depreciated each component until it needs to be replaced, the moment you replace it, you recapitalise the item again. So, you then end up with an asset that goes back up in value and you start depreciating over the life of the item again. So, I'm going to have to do it. What's this? It's a plane. So, in the plane, you're going to have the body of the plane, which is going to last maybe 30, 40 years. The wings might last 25, the interior is going to be fairly disgusting after 5. So they would write that interior off over 5 years, write the wings off over 20 years, and write the body of the plane off over a much longer period. It doesn't just have to be a property, it can be any substantial piece of property, plant and equipment. So you might need to start looking at the assets that you've got. If they've got quite a long useful economic life, does that useful economic life apply to the whole thing, or does it apply to the different components in different proportions? And again, that's going to fundamentally affect your depreciation charges and your profit and loss.
There's a threshold for that.
There isn't. In theory, you can think about what's material, but if you were looking at Ian's laptop and a mouse, I probably wouldn't bother breaking it down into components, but it does tend to be the big items of plant and equipment. So if you've got I don't know, big industrial equipment, printing presses or something that will last for a considerable period of time, it's whether or not there are different components that need replacing within that. Now, similar basis applies to items that need to be repaired on a regular basis. So, imagine that you've got your ferry or your plane. I keep doing my plane. If you've got a ferry or a plane that has to go for an overhaul every few years, or it could be that you've got a piece of equipment that has to be overhauled and has to have a set repair regime. So for the gentleman from the railway, it may be that you actually need your engines to meet their health and safety requirements on a regular basis every 5 years, whatever the criteria will be. What you would actually do there is look at the cost of the repair or the overhaul. You would depreciate that cost over, say, a 5-year period, whenever the overhaul and repair is due to take place. And then as soon as you incur that inspection cost, or you have the major overhaul, you have written off the old bit and you recapitalise and start again. It's a different way of thinking about your fixed assets. We've not had to do it in the UK before, but it's going to be important for some of your businesses. If you've got big substantial items that need regular inspections, regular overhauls, or different bits drop off them at different rates, you're going to have to look at your depreciation charges on a different basis. Deferred tax. Now, most of the changes in policy that I've already run through actually involve the use of fair values. So we've been looking at your property, plant and equipment, any brands, your goodwill, all of those areas. Whenever you have a fair value, you're now going to have to account for the deferred tax on that fair value. Now, I was hoping that a friend of mine, Marion, would be here this afternoon so I could pass across to her and drop her in it and ask her to discuss the tax changes. The general idea is that where we've always had timing differences for our deferred tax calculations, where you've looked at your capital allowances, you've compared it to the book value of your assets, and you've worked out how much extra tax you're going to have to pay over time, you're now going a little bit further. You're now going to have to look at any revaluations, you're going to have to look at deferred tax on business combinations, and you're going to have to look at deferred tax on things like financial instruments as well, that I haven't actually talked about today. I would suggest that you work with Ian's tax department closely on this one so that they can see the full consequences of what you're going to do. If you are having to revalue anything or you are using the fair value methods, then you will actually have tax implications here as well. In most cases, the new deferred tax liability under FRS 102 is going to be much higher than the deferred tax liability under UK GAAP. So you could see a bigger figure in your balance sheet and a bigger charge hitting your profit and loss account. But then over time it should ease down a little bit as you get used to the fair value accounting. So I will quickly leave deferred tax before anyone asks me anything complicated. Now, what we've run through at lightning speed, first of all, the company size criteria. So I don't know if any of you are going to be moving from being a medium-sized company down into a small company, or whether most of you are staying where you were. But it's worth looking at those transition rules. You may decide that you want to actually step up and apply the full-blown version of FRS 102 simply because you're a growing company and you know that people will expect you to have the full standards. For your timetable for transition, every one of you is already within that transition period already, which is why Ian wanted the Christmas tree in the background to make you think, actually, yes, we've got to start doing something. So, if you have got a December year end, you've got to go back 2 years already to work out the values. If you're a small company, you've got a 12-month gap before you have to do it, but you still need to start looking at the transition balance sheet from the 1st of January 2015, or whenever the start of your accounting period was in 2015. So you've got to work out your values, you've got to look at what's going to change, you've got to make sure you've got access to the information. I cannot recommend strongly enough running through some of the checklists that are available online for identifying the changes. I know I've been working on a few projects where I've been going through looking at some of the key accounting changes that are required, but obviously as a third party, I cannot possibly go in and say, these actually apply to your particular business. Ian and Jen are in the same position as well as auditors. They can give you information, but you've got to make the choices yourself. You have to decide for yourselves which parts of the standard apply to your business. So the best piece of advice I can give you is to start thinking about the changes now.